right, folks, how you doing this morning? It is time now for your Sunday Money, and we've all heard of the power of positive thinking, but imagining failure is actually one of your best tools for achieving financial success. Paul Fain, president of Asset Planning Corporation, joins us now for a look at that. And Paul, when we talked about it just now, I was surprised that we were talking about this. It's not enough to have a sound financial plan.
Well, it's so true, Sean. It's one thing to have a plan, it's another to stick with it.
Yeah.
Because, certain sectors of the economy go up, some go down. Stock markets can tank. Even the bond market can, have a bad year. So what happens is investors start to second guess what they've decided to do, and then they start tinkering and changing things.
Yeah, sometimes that is not good. Really, in fact, investors consistently underperform the market. I feel really cool saying that. I mean, this is what we were just talking about.
Yeah.
I mean, it's pretty nuts, right?
Yeah, I mean, if you look at 20-year history of just the U.S. stock market measured by the S&P 500, and then look at the results of the typical investor during that same time period, there's about a 2% difference in performance. The markets outperform the investor by an average of about 2%.
Huh. That's really interesting stuff. I know the S&P 500, a big index as well. Let's talk about our fast market fact this morning. Paul, what do you got for us?
Well, we can see the delta between what the stock market's done and what the average investor does. Stock market investor, because they're reactionary, because we panic when the markets go down. We buy and sell at the wrong time.
Yeah.
So for our fast market fact, let's look at the bond market.
Okay.
Because they're sleepy, boring bonds, right? You can't mess that up. Actually, the long-term bond index, the aggregate bond index, has averaged, about 4.5%, as we can see here. The average bond investor over the same 20-year period ended in 2008 averaged 0.22%. So 4% underperformance. Big difference between that and the stock market investor that was lagging by about 2%. So here again, the story is you've got to imagine yourself in the future. We call it, a mental roadmap, and say, if I'm successful 20 years from now, come forward and say, what would I do to be successful? But also consider, failure. Look at what our investors have done compared to the market. If I look forward 10, 15, 20 years and I've not achieved my goals, think in the present what I can do differently to achieve success. So if we see obstacles, Sean, we can try to avoid them, and if we can avoid them, we can do a lot better job investing.
It's really interesting. Yeah, it helps you kind of formulate that plan by kind of thinking backward a little bit almost.
Yeah, exactly. It's just like going on a trip. If you know what the obstacles, where the wrecks are, you can get a lot better, farther along, a lot faster.
Get around them. Awesome, Paul. Thank you so much. And if you have a question for our money man, you can email him at paul@assetplanningcorp.com. I know he really enjoys getting questions from the viewers. Paul, thank you so much.
That's great.